Good morning and welcome to the Monday Market Update. I'm Nash Paradise, joined by no one this week. Mr. Katie has the week off. Plus, he just didn't really want to be here because nothing that we look at matters, and economic data is completely irrelevant. No, not completely, but it's been mostly irrelevant. So let's jump right into it. We'll be pretty quick this week as we look at what happened. Last week, rather not revisit. Highly volatile. It was rough. It's like getting punched and then kicked and then punched again. And then you start to get up a little bit and then you get knocked out. Things did not go our way as we got late in the week. And there wasn't necessarily much reason for anything. There was no econ data. You've got, markets overreacting to the anticipation of, de-escalation, and then it goes the wrong direction. And then just when you think the market's taken all that it can and we see some ceiling on treasury yields, they absolutely blow through those. So end of the week, considerably higher at that 6.64 mark, still in the mid sixes, which is not the worst spot in the world to be. But, if you listened to us last week and we said, hey, on Monday, things have gotten a little bit better, get it locked in, you were probably happy with your week because you protected your buyers. And last week's late week was rough. Getting into what happened, let's talk about the financial data from last week. Mostly irrelevant. S&P didn't really move the needle. No big misses. Nothing really interesting happened. Any of the initial jobless claims was fairly relevant just because it hit straight on the mark. Continued claims were very flat as well. So nothing of note from the econ data last week. So let's get into what we're looking at this week, because this week we got the first Friday of the month, which means jobs, means the big unemployment rate, non-farm payrolls. These things we care about, and this is going to be on Friday. Non-farm payrolls are anticipated to come in pretty low at 55,000. This is after a previous report that had a negative 92,000. So if we can get that flip into adding some jobs, that's what the market is expecting. Unemployment rate is set to remain unchanged at 4.4%. But with everything going on right now, markets are eyeing the labor data to see, as inflation is moving up, what's going on in the jobs market. Lately, we've been dealing with, inflation has been holding steady, but jobs have not been great, not been growing. I feel like it's still a little too early to see any impact from the, Persian Gulf conflict on the labor market, but we'll see. Things could move pretty significantly on Friday. There's much more of a swing potential for things to get worse than better. So I would not be holding anything on until Friday. Early in the week, we got a couple of Fed speeches. On Wednesday, you've got all this ISM PMI data that would normally be fairly relevant. It's not in this market. No one really cares about construction spending and, the producer price index when we've got tweets. So let's move out of this week and talk about what has been going on with the Fed funds rate. This is proving to be very irrelevant this year as well. This is the Fed rate, and everyone cares about the Fed rate until they realize that the Fed rate is a lot less important than everything else in the market, and these really don't have a huge impact on anything because everything else is having impacts on everything. So we're at a good spot right now, that 350 to 375 forecasts, even with a new Fed chair coming in, have this staying the same all the way through this year. through most of next year. And now, because things have improved slightly, you may remember last week, it was basically a straight blue all the way down. Now we're seeing some potential for a cut maybe in late 2027, when we were looking at 2 cuts this year. Now we're solidly at 0. So moving in that wrong direction as far as Fed funds cuts. They're going to stay up here to protect and hedge against inflation. I guess the good news is on this chart, you don't see anyone projecting a rate increase, even though, Europe and, some Eastern markets have been forecasting the possibility of a interest rate hike. We have stayed higher than them anyway. So we're already up there. If they do increase interest rates, that doesn't look good for us, and it's not great for our outlooks, even though we have a higher Fed funds rate anyway. So it shouldn't matter. It does matter. And thankfully, we're not looking at things getting worse on this. So let's get to the big chart and the big ugly. We've given up a lot of ground, and we're all the way back to where we were mid-September of last year. So mortgage rates are up. Every time they go up, looking at these charts, you see this huge escalation. You think, oh man, okay, well, we're there. Now, how am I going to deal with this increase in pricing, this drop in mortgage-backed securities yields? And, you start to compartmentalize and say, all right, well, the damage is done. Where do we move on from here? And then you get hit again and again. So we've got all these significant drops, tiny little bounce backs, and another significant drop. We're actually living in the bounce back right now. If you haven't looked, mortgage-backed securities are very green right now. We're at, plus 48 basis points, which is a fantastic way to start the Monday. 10-year yields have come all the way down to 4.34. They were up in the 4.4 range. So about 0.1%. We've improved on that, but there's not a lot of good reason for it. There's not a lot of support there. Bonds are finding buyers, and markets are just waiting to react to things right now. So you could call this a bit of a leveling off after last week's, rapid, increase in the treasuries. Who really knows for sure? It's not bad news when things are green. Green is good. So Monday is a good day to lock stuff in. Looking at this chart, we are like we were last September. The other good news from here, and we can go ahead and move on slides as we're talking about what is going on with mortgage rates and what we're seeing in the market right now. Good news is buyers are showing up. The spring buying season, people are not afraid of 6.5 interest rates, 6.6 interest rates. They were excited about 5.99s, and that was great for everyone. But it still feels like, and we see it based on national application averages right now, people are still coming out to buy. Markets are still depressed in a lot of areas. Lots of seller concessions, lots of price reductions. In areas where there is inventory and price points where inventory exists, buyers still have a lot of leverage. So even at a 6.6%, there's still all that leverage that existed, when you had it at 6%. And honestly, some of these buyers are going to have better wins because now they're not competing against a lot of other people who would be jumping in if rates were, in the upper fives right now. So my takeaway here this week is find the wins, communicate effectively with the market, with your sphere, with your potential referral partners, letting them know who's winning right now. What are you seeing? What are we seeing collectively? Is buyers are showing up and they're winning. They're getting better prices on homes. They're getting more seller concessions. And yeah, they're also getting a higher interest rate, but not so much higher that their buying power has changed significantly. Getting that $10,000 to $15,000 off the price of that home is making up for the increase in the interest rates. And we'd like to think that once, everything is completed with the Iran stuff, hopefully it's not going to be another, 20-year Afghanistan deal. But as we get some stability on oil prices and we see, things moving forward and, as consistent a way as possible, we should see interest rates eventually bounce back close to where they were before. So maybe that's refinances in the future for these people. Who knows? Whatever you do, don't say, marry the house, date the rate, because that's awful and stupid. And those people were dating the rate for like 3 years. You should have put a ring on it because it was permanent. Not a good long-term solution. I also don't think that buy downs are going to become a very popular situation right now either. That's really grasping for straws. And you don't have to do that in this market. Mid sixes is still a winning market compared to where we've been. And, spring buying season is hot. So make sure your attitude, your energy, and your focus are dialed in and positive. go find the wins where they need to be found. And we'll check back in next week after we get the Friday jobs report, see where we're looking from there. Till then, thank you everyone for tuning in. Y'all have a good one.